On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice and it doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risk and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services or to view the Craig's Investment Partners Financial Advice Provider Disclosure Statement, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Please engage with us. We love to get feedback, questions, and comments on this material, and if you enjoy it, please rate it, or even better, share it with a friend or colleague. G'day team, hope everyone is well. I'm back after having last weekend off. Apologies that I wasn't here to produce one of these reports. Actually, I'm not really sorry at all. I was at Magic Round having a blast, so no apologies from me. But I am back on deck and no more weekends away planned until the July school holidays, so back to normal service. Right, let's go through everything that we saw across markets and economies last week, then let's turn our attention to what we need to focus on in the week ahead. It was a more stable week for global markets. Investor confidence has been buoyed by hopes that we will see trade deals, and we had that news that the US and the UK had reached a preliminary agreement. That's good news. It does suggest that the 10% baseline tariff that will remain on UK goods will be the baseline everywhere else too. So I think that is something we can potentially take from what we saw last week. Still, markets are hopeful that global recessionary risks have receded and that you will see some level of de-escalation. So I think what's next immediately on the tariff front will be the outcome of talks that are taking place over this weekend. I'm recording this on Saturday morning, so we haven't had any news yet, but talks over this weekend between the US and China. That does offer some hope for optimism. We'll see how markets react to that early next week as we get some news flow about what came out of those discussions. But the S&P 500 in the US and the FTSE 100 in the UK both fell last week, but only slightly, down 0.5% for the week. European and emerging market shares were up slightly. The Japanese Topics Index was up 1.7%. It had a better week. Across the Tasman, the ASX 200 was flat, while the local market, the NZX 50, had a very good week. It was up 2.2%, and that sees it up 5.9% in May so far. And it is early days, I know, but that puts it on track for its best monthly performance in 5 years. You've got to go back to April 2020 to find a month where the market was up more than that, more than 5.9%. That was obviously the first month of recovery after that COVID bear market that we saw back in early 2020. So the local market has had a good couple of weeks. Interest rates were up slightly. We saw the US 10-year Treasury yield finish the week at 4.4%. The New Zealand 5-year swap rate was also marginally higher. It finished the week at just under 3.5%. Right, let's turn our attention to some of the key releases and events from last week, and we'll start here in New Zealand. We had the March 2025 labour force report, unemployment and so forth. Good news on this front because the unemployment rate was unchanged at 5.1% in the March 2025 quarter. That was below market forecasts, which were expecting an increase to 5.3%, and the Reserve Bank was also expecting an increase to 5.2%, but we didn't get that increase. It was just steady at 5.1%. So that's good news, better than expected. However, unemployment's still sitting at its highest level since the September 2020 quarter. Back then it hit 5.2%, and apart from that 1 3-month period, right now it's the highest we've seen since 2016. So we'd still rather unemployment be a little bit lower, but at least it's stopped going up. Less positively, the underutilisation rate, which gives a broader measure of untapped capacity in the labour market, and this might look at things like people working part-time, but they really want to be working full-time, so they're not technically unemployed, but they're not getting as much work as they would like or need, or people that are wanting more hours or things like that. So that measure of labour market slack, that increased from 12.1% to 12.3%. So it is going up, and that's actually sitting at the highest since 2020. So maybe what you're seeing is unemployment's not going down, but some people have had to move into part-time work or something like that. In terms of wage growth, it slowed. Private sector wage growth running at 2.6% per annum. That's the lowest since late 2021, and public sector wages grew at the slowest pace in almost 2 years. So you put all that together and you've actually had a stronger outcome in terms of that headline unemployment rate not going up as it was expected to, but the wage growth was a little more moderate than expected. So in terms of the Reserve Bank and the OCR, what does this mean? Well, not a lot really. Markets still see another 0.25% rate cut as a certainty at the end of this month, and then the market expects 2 more cuts of the same magnitude over the balance of this year. So right now the OCR is at 3.5%. Remember, it peaked at 5.5 last year. So it's 3.5% now, expected to come down to 2.75% by the end of this year. That's market forecasts. I know some of the economists see it bottoming out still in the 3s, but that's where financial markets are at right now. Right, what else did we get last week here in NZ? Dairy prices. Some more good news on the agricultural front. The latest global dairy trade auction results were very pleasing. The headline GDT index up 4.6%. That's the strongest rise that we've seen in 6 months, and it's the 3rd consecutive gain. So prices are up more than 10% this year. They're at levels we haven't seen since the middle of 2022. They are still about 15% below where they got to in 2021. That was about a 15-year high, but they're at very high levels compared to the last few years, and a Fonterra payout of at least $10 appears to be locked in for this season. We should get confirmation of that later this month. It's usually in May where Fonterra does confirm the payout and give an opening forecast for the next season. So we should later this month get confirmation that the season that's soon to end will see a payout of $10 or more, and we'll get that opening forecast for the 2025-2026 season. And I reckon it'll be pretty close to $10 as well. You might get back-to-back $10 payouts. Wouldn't that be fantastic for rural New Zealand? Right, further afield, it was also a busy week last week. We had 2 major central bank meetings, the Federal Reserve in the US and the Bank of England. And the Fed was the big one. As expected, no change to policy settings. They left the Fed funds rate, or the upper bound of the Fed funds rate, that's their equivalent of the OCR essentially, they left that unchanged at 4.5%. It peaked at 5.5% last year, same as us, but they haven't come down nearly as much. We've come all the way down to 3.5. The Fed has come down to 4.5, and they're on hold. They did talk about the uncertainty around the economic outlook, how that had increased. They noted risks to both sides of their mandate. So they've got a mandate that says you want to keep unemployment low, but you also want to keep inflation subdued, and there's the potential for higher unemployment, but there's also the potential for higher inflation. So they are getting sort of pushed and pulled potentially in 2 different directions. They've got a slightly trickier task than some other central banks might have. The US economy has been in good shape, but it's the tariffs that are really threatening to aggravate that inflationary backdrop and slow economic growth. And that is quite an uncomfortable combination for the economy, for investors, and certainly for policymakers. So on the back of that announcement that the Fed didn't change interest rates, while it was expected, we all looked very closely at the tone, looked very closely at the wording, followed Jerome Powell's answers in the press conference, and when you put it all together, markets did pare back expectations for a rate cut at either of the next 2 meetings. The next meeting is in June, and current pricing suggests just an 18% chance of a rate cut, so not very high. That rises to 68% in July, so July looking much more likely. And over the course of the whole year, financial markets see 2 rate cuts as definite, possibly 3, depending on how things go. So 2, maybe 3 rate cuts over the calendar year, but July at the earliest in the eyes of financial markets. Different story in the UK, where the Bank of England did ease policy further, so it reduced its policy rate by 0.25%. That takes to 4.25%. That's the lowest in 2 years. That was the 4th cut of this cycle from the BOE. Their policy rate hit a 15-year high of 5.25% last year. While the cut was expected, markets had expected there to be a unanimous vote, but we didn't see that. The committee voted 5-4 in favour of this cut. Of the 4 that voted against it, 2 actually wanted a bigger cut. 2 wanted 0.5%, 50 basis points, and the other 2 would have rather leave rates on hold. So there is definitely a bit of divergence around the table in terms of that monetary policy committee for the Bank of England. Softer inflation, in part due to lower oil prices, was a key reason for the cut, while the committee also noted that global growth prospects had weakened in the wake of those trade tensions. So markets see 2 further 0.25% cuts this year, and the next move most likely in August. Right, so that was last week's key releases. Turning to the week ahead, and we will be watching economic indicators for any signs of an impact from those tariff announcements that came out in early April. This is really when the April data starts to come through. So this will be some of our first indicators of whether we see a change or whether we don't. We all know that the confidence figures, the sentiment figures have been hit, but so far we haven't seen any impact in the hard data and the actual economic releases. So we'll find out this week if that's the case. We've got US inflation that is out on Tuesday. Markets expect it to remain steady on last month. The headline CPI expected to have increased 2.4%, same as last month, the lowest in 6 months. And the core CPI expected to remain unchanged at 2.8%, again the same as last month, but last month's was the lowest in 4 years. So we're nicely in the mid to high 2s, but everyone wondering if those inflation rates creep up in the wake of the tariffs. That's out on Tuesday. We have also got retail sales. I think those are out on Thursday, and we've got the NFIB survey, which is business confidence, and the University of Michigan survey. So lots coming out in the US this week. Inflation probably be the highlight. Fed Chair Powell is also speaking on Thursday in Washington, D.C. Given that he spoke last week in the wake of that Fed decision, you wouldn't expect there to be much new information that he could share with us, so it'll probably just be a repeat of what we heard from him last week, and markets will also obviously be monitoring the outcome of those trade talks between the US and China that are taking place this weekend. That's globally, or at least in the US. Here in New Zealand, we've got electronic card spending and migration. Those are out on Wednesday. We've got selected price indexes on Thursday. That's the early release that we get from Stats NZ that gives us a bit of a heads up about where our inflation is headed. We've got the Reserve Bank's quarterly survey of expectations. That's due on Friday afternoon. We should also get the latest housing report from the Real Estate Institute. That should be out this week too. Things get busier locally over the balance of this month. You've got Budget 2025. You've got a swag of corporate earnings releases, including releases from the likes of Main Freight, Fisher & Paykel Healthcare, Ryman Healthcare. So it's a really busy period over that second half of May. You've also got a Reserve Bank decision in late May. And that's a monetary policy statement as well. So not only will you get the OCR decision, you'll get the new forecast set, which is always really interesting. So the second half of this month in New Zealand will be very, very interesting with those things. The budget, the monetary policy statement, we expect an OCR cut to be part of that, and you've got a ton of really important corporate releases. While we're talking corporate earnings, the global earnings season largely complete. It does start to wind down this week. It's about 90% complete in terms of the number of S&P 500 companies that have reported. So far, it's been pretty good. Almost 80% have exceeded earnings forecasts, and the annual earnings growth rate in terms of the March 2025 quarter compared to the same period a year ago is currently sitting at about 13.4% in terms of that annual earnings growth rate, so not bad at all. There are still several companies worth watching this week. We will hear from the likes of Burberry, Sony, Tencent, Alibaba, Deere, Walmart, so a couple of heavyweights to keep a close eye on. Right, that's it for this week, team. Always good to chat. Appreciate your attention. We will talk again soon. Thanks for listening.
For more insights, visit craigsip.com.